Most of Nvidia's earnings reports this week will tell you that they crushed it. That's true. They'll also tell you that the stock dipped after those earnings reports, which is also true. But the real story is a structural shift that takes 10 years to play out. And if you're interested in investing in the next decade, then stay tuned to this video because it's the only Nvidia video that you'll need to watch. Moreover, if you're interested in long-term investing, subscribe to my channel. I post at least 5 videos per week for long-term investors. Now let's get into the subject of this video, which was the Nvidia earnings report and how it plays out for the next decade. The numbers they reported themselves were so good, but they're kind of a trap because they hide an underlying story behind them. Nvidia reported Q1 fiscal this week. Revenue was $81.6 billion. Wall Street estimated $79 billion, so they already beat that. Earnings per share, $1.87. Wall Street expected 77 and they beat those numbers also. Guidance for next quarter is between 89 and 93 billion. Wall Street expected 87, so that has been raised. Moreover, they also hiked the dividend. And the headline number, the data center business, which is essentially the AI business, which is the whole business, came in at $75.2 billion for the quarter. 1 year ago, that was $39 billion. So it's almost doubled in just 12 months. Now let me say that again because I want you to feel the size of that. Nvidia's largest business segment, which is already the largest business segment in semiconductors, doubled in a whole year. There's no company in modern corporate history that has scaled an $80 billion per quarter business at this speed. Not Apple, not Microsoft, not Amazon, nobody. And after Nvidia reported all this, the beat, the raise, the dividend, the doubled segment, the stock fell. So the question is obvious, and it's the question I want to answer in this video. If the quarter was so good, why did the smartest money in the world sell it? Now the answer wasn't in the income statement, it was in the news the same week. In the 7 days surrounding Nvidia's earnings, 3 things happened. 1. Anthropic, the company behind Claude, one of the 2 most important AI labs in the whole world, signed a deal with Amazon for 5 gigawatts of their chips. Not Nvidia's chips, Amazon's chips. OpenAI, the company behind ChatGPT, the most valuable AI company on earth, some might say, also signed a deal with Amazon for 2 gigawatts of their tranium chips. Again, not from Nvidia, but from Amazon. Now 3, Google reportedly signed a multi-generation, multi-gigawatt deal to supply Anthropic with its own TPU chips. So Anthropic in the same month signed up for both of Nvidia's biggest competitors in chips. Now I want you to understand what's happening here, because the financial press I think is not really framing it correctly. Nvidia's 2 most prestigious customers, the AI labs whose growth defines the entire demand Nvidia serves into, just publicly committed to 7 gigawatts of compute on somebody else's chips. 7 gigawatts is not an experiment. That's enough power to power 7 nuclear reactors. And that is a strange decision to build production AI workloads on non-Nvidia chips at scale. And it wasn't just the labs. Amazon disclosed on its last earnings call that its in-house chip segment is running at 20 billion annual rate, growing at triple-digit percentages year on year. AMD is shipping rack-scale server systems this year, and Cerebras, which makes a fundamentally different AI chip, IPO'd last Thursday. So for 3 years, the bull case on Nvidia was simple. AI infrastructure spending is a tidal wave, and Nvidia holds the monopoly on that. But last week, we've seen new competitors coming into the fray with serious deals being made. And if you've been investing for more than 10 years, you've probably seen something like this happen before. In the year of 2000, Cisco Systems was arguably the most valuable company in the world. $500 billion in market cap, which in today's translation is roughly $1 trillion, and they built the routers and switches that ran the entire internet. Every telecom carrier, every data center, every enterprise, they all bought from Cisco. They were the company that owned the plumbing of the internet, essentially. 26 years later, in 2026, Cisco stock has still not recovered to its 2000 peak. And that sentence often gets misunderstood, so let me clarify it a little bit more. Cisco, the company, is fine. Revenue is higher than it was in the year 2000. Profit is higher and the company still exists and still dominates parts of the market and still pays investors a dividend. The stock didn't go to zero, but it spent 25 years basically going nowhere. So as an investor, it wasn't really so great to invest into. And this is a lesson that's important for modern investors. When a company's customers have the capital and technical talent to become its competitors, the monopoly is only temporary. The revenue can keep growing, the profit can keep growing, but the multiple what investors are willing to pay into and consider as a great investment generally don't keep going up. And that's what may happen to Nvidia. It's not the death of the company, it's not really a great company possibly to invest into long term anymore. It may well be at the peak. So let's get practical. What does this mean for investors today? I want to lay out two scenarios and I'll tell you up front which one I think is going to happen. And I'm not saying that I know, I'm just saying what I think will happen, because anyone who says with certainty that they know will happen is probably trying to sell you something. So scenario one that might happen is that Nvidia keeps this monopoly. And in this scenario, they stay at 30 times earnings, the revenue keeps doubling, and the stock keeps going up. Scenario two is what we just talked about in the beginning, that those competitors come in and start taking up parts of the market, start manufacturing their own chips, and their current customers, Nvidia's current customers, go to the competitors. Now, Nvidia's revenue will keep growing, maybe even keep doubling for a few years, but the multiple of the stock going up starts to compress, and the stock goes not really anywhere fast, even though the earnings keep rising, which is exactly like Cisco. And I think this scenario is probably more likely because that's just the nature of business, that competitors come in and market share gets taken up a little bit in different areas. And for Nvidia, it's unrealistic that it can keep skyrocketing forever. At some point, it's going to plateau for the reasons that I mentioned. And that's not a question of whether it's a good company. Of course, it's an amazing company, but as an investor, it's something that you need to be aware of that could likely happen. And that's something that you need to consider when you're looking at the valuation of this company, considering whether to keep investing into it or start trimming your profits. If you want to learn more about those subjects, check out the other videos in my channel where I discuss about valuations of companies, trimming for profits, and finding out if it's a good investment. And if you enjoyed this video, please subscribe for more to my channel. Thank you.